Welcome, everyone. I'm Angelo Robles to the Angelo Robles podcast. I'm also the founder and CEO at Family Office Association. Really excited about today's podcast. It's Rick Rule, CEO of Sprott. Why gold? Why now? Of course, it features Rick Rule, CEO at Sprott US Holdings. Rick, welcome to the show.
Pleasure. Thank you for having me on, Angelo.
It's great to have you here. Let's get right to it. MMT advocates contend governments that have their own national currencies do not have budgetary constraints. The belief is, no, they can't run out of money. Therefore, a government does not need to worry about accumulating large debt. What are the eventual consequences of this?
I think the consequences are fairly obvious if you study history. Modern monetary theory isn't new. It's been practiced by governments when they had to since time immemorial. Things like scraping silver off the sides of coins to debase the currency in that regard. Angelo, if you engaged in modern monetary theory, it would be called counterfeiting, and you would be put in jail. If you're a congressman, it's extremely popular and it gets you reelected. But the truth is it debases the currency. It makes people over time concerned about maintaining the purchasing power of their savings, and as a consequence is disruptive, at least in investment markets, even at the same time that perhaps the liquidity buoys equity markets from time to time.
And what would be signs that the Fed is losing control, assuming it hasn't happened already?
I don't think it's happened already because I suspect the first place that shows up is in confidence. And confidence would seem to be fairly high. I think many investors, probably not many family office investors, but many investors, particularly say the Robinhood crowd, are confusing two words in English. One being liquidity, the world is awash in liquidity, but the other being solvency. The circumstance of debt and deficits at the federal level, the state level, the local level, and on many individual balance sheets is a bit more problematic. Of course, people don't feel the solvency issue as long as they're liquid. But if you take away the liquidity and you've taken away liquidity and solvency, then a very different circumstance presents itself.
For sure. Does MMT overestimate the revenue that can be earned from money creation? Let me put it slightly differently. It's like a drug that you will need more and more of to be effective. It kind of feels that way.
That's a very good point. When you stimulate economic growth by stimulating liquidity, what you really do is you forward shift it, which is to say you take demand that would have occurred in 2022 or 2023, and you enjoy it in 2021. That's great until 2022 comes, and you have to replace the demand that you stole it from in 2021. One of the difficulties I think we face as a society is that we have done, through adding excess liquidity, so much forward shifting of demand that each additional dollar of stimulus spending buys us less and less growth. With the caveat, of course, that in fairness, I'm a credit analyst, I'm not an economist. It's just very difficult for me to understand how ultimately liquidity becomes a replacement for solvency.
For sure. Is this the policies that we're going through inflationary? So my question to you, probably my bigger picture question relative to that is I think the whole CPI is just made up baloney. A lot of it depends. I mean, I'll give you this example, and my audience has heard this before. Living in a penthouse in New York, buying homes in the Hamptons and Malibu, buying NFL teams. I mean, my God, to buy those assets or buy more of them, that's not going up at 2 or 3% a year. Isn't it very personal?
Well, you've put a whole bunch of interesting things into that question. The first thing, inflation versus deflation, you could make a case for both. Excessive debt and the process by which you eliminate debt, which is to say a default cycle, is deflationary. The policy response to deflationary pressures is money printing and the debasement of the currency. which is, of course, inflationary. I know you want a simple answer from me, but I'm not smart enough to give you one. And in terms of the inflation number, again, I'm no economist, but I would suggest to you that the people who compile the CPI don't shop where I shop. They buy a very different basket of goods and services, which is problematic. The other thing about the CPI number that really bothers me and always has is it doesn't include tax. I guess if I didn't have to pay the tax, I wouldn't complain so much about the index. But when people talk about the purchasing power of my earnings and my savings, and I suspect the same for your listeners, you can't deny the impact of tax. And in order to properly gauge inflation too, I think that you need to look at the inflation that is being built into the circumstance by the increase in debt. That is the sort of structural inflation that we seem to be building into the circumstance. A situation, I mean, this is a double-edged sword, a situation where there's artificial liquidity and artificially low interest rate, frankly, benefits consumers of capital, many of whom are probably listeners to yours, to the extent that, as an example, you can lock in a 30-year fixed commercial mortgage at a very low rate, which is to say that you fix your cost of capital and then invest that in a decent piece of commercial real estate where your return on capital employed increases over time, means that the circumstance that we face is a double-edged sword. It has a negative impact perhaps on the overall economy and on your savings, but it can be a wonderful tool to employ in the interim too.
And this is a simple question, but sometimes it could be a little difficult to answer. What questions should a wealthy family, a family office be asking on modern monetary policy, looking at the big macro picture? They can't look at 70 different variables. What are 1, 2, or 3 things they should be concerned with?
Well, I think you need to look, particularly for wealthy families, at what impact this might have on their bond portfolios. Many of the family offices that utilize the service of Sprott have employed fairly traditional asset allocation models over time, which is to say that their portfolios are as much as 40% bond-centric. And a negative real yield really calls into question how much of your portfolio can or should be in bonds, how you should hedge the bonds, and it particularly calls into account duration. 10-year duration, as an example. If you remember back to the decade of the 70s, the last time I would argue that the government lost control of both inflation and the interest rates, decimated the value of long-term bonds. I'm not saying not to hold bonds. They've been an important part of my portfolio over time. But you do need to consider the fact now that many bonds, as Franz Pick would have described them years ago, are certificates of guaranteed confiscation. If you look, as an example, at the arithmetic behind the US 10-year Treasury, last time I looked, it was yielding about 100 basis points. And the Congressional Budget Office suggests that the US dollar is depreciating at 1.6% a year. That means the US government is absolutely positively guaranteeing you a 60 basis point compound loss for 10 years running. Refreshing, a promise that they'll be able to keep. But when you ask the question that you asked me, that is to say, what do you need to think about in terms of your portfolio? The first place I think that you look is in your fixed income obligations and what impact that might have on your family's purchasing power in the intermediate term. And that's a sort of a scary circumstance. I guess another thing that family offices need to confront is are artificially low interest rates responsible, and if so, how much, for the level of equities valuations that we see today? If companies are enjoying an artificially low cost of capital because their debt service charges are lower than they would be in the free market, and if you believe too that artificially low interest rates increase the capitalized value of an income stream from dividends, One could argue, and I'm not making this case, as I say, I'm a credit analyst, I'm not an economist, but one could make the argument that many conventional equities portfolios are overpriced as a consequence of artificially low interest rates. And if the interest rates were to correct, that might impact both the valuation metrics for equities and their ability to earn money because their cost of capital might increase. I think those are the things that family offices need to begin to address.
Yeah, those are very good points. And broadly, what do you think about 10-year Treasury yields?
The idea that the government absolutely positively guarantees me a 60 basis point annual negative yield doesn't sound like too much fun to me. When I look back over 40 years of US 10-year Treasury yields, they have traditionally offered 150 or 200 basis point positive yield relative to CPI inflation. Were that the case, if the base yield now is 1%, in a historic sense, the US 10-year Treasury should be yielding about 3%. If we had reversion to mean, which is to say that the expected yield went back to 150 to 200 basis points positive, what that would do to the capitalized value of the distribution of the US 10-year Treasury right now would be ugly, like it was in the 70s. I'm not making a prediction. I'm just answering your question, holding that out to people to think.
And what is your opinion? It seems like so many different experts, it's probably 50-50. Are we heading into deflation and then inevitably inflation and hyperinflation, or skipping over deflation, going right to inflation, or neither?
That's the $64 billion question. As I say, there's plenty of deflationary pressures in the economy.
Yes.
The way the big thinkers of the world always seem to deal with deflationary pressures is by inflationary means. I think the conflict between inflation and deflation means that the one thing that's certain going forward will be volatility. I'm not ducking your question, by the way. I'm trying to say that I can make a case for deflation, and I can make a case for inflation. The case for deflation, if you're an American, I think is fairly simple. There's $26 trillion in on-balance sheet obligations at the federal level, 20 trillion net. That's 12 zeros, which people forget about. And there's probably $120 trillion in off-balance sheet liabilities, which is to say net present value of entitlements. So our collective obligation at the federal level, before state and local obligations, is somewhere in excess of $140 trillion. And we service that debt with the national income, taxes and fees, less expenses. Unfortunately, that number is negative too, about $3 trillion a year. So rather than service the debt, we in fact add to it. There's no real way that I can think of out of this hole. You either default, that is to say, you tell the old folks like me with regards to Social Security and Medicare, too bad, so sad. We made a promise, but we're not going to keep it. Difficult thing to do politically. Or you inflate away the net present value of the obligation in some fashion, much as we did in the 1970s.
Right.
It's sort of an ugly choice in the intermediate to long term.
So in terms of looking at it from an investing perspective, cash and bonds, I suppose, would be good in a deflationary environment. And you can make the argument, maybe, and again, a $64 billion question, is that going to be happening? But I am more in line with you that even if it takes a little while, it's going to skew more to inflation, and some of the reasons for the wealthy, depending on if they're living that lifestyle that I noted, it's going to be harder and harder. So you're correct. If you have your money, of course, you got to have some, I get it. But if you got 30-40% in cash and 10-year US treasuries, boy, you're getting crushed on your purchasing power.
I'm attracted to cash for several reasons. I understand completely that cash balances reduce my purchasing power over time. But cash does something else for me. It allows me to sleep nights and stay calm. and
it gives you dry powder for strategic purchases. That's true.
That's the other thing. Cash gives you the tools and perhaps the courage, if we have a circumstance like we enjoyed, if that's the right word, in March of last year or in 2008. If we have a a crisis in confidence, having reasonable amounts of cash allows you to take advantage of the circumstance rather than being taken advantage of. But I also think that the preponderance of evidence suggests that the social and political forces around the world, but in our country too, quantitative easing, debt and deficits, negative real interest rates, favor at least the probability that we're debasing the currency, and that the purchasing power of your savings and more conventional savings instruments will be challenged, which is to say the perfect case for gold investment. So gold, yes. Cash, yes. US 10-year treasuries, not so much. I want very short durations on my cash, even at the expense of yield.
And when you're looking at, I mean, the whole world is being impacted by what we're seeing in a global economy and COVID. And definitely we have challenges here on multiple different fronts. But do you believe that the dollar will be the world's currency, at least for the foreseeable future, because everything else is getting crushed, if not worse?
I absolutely do. My friend Doug Casey describes the US dollar as the prettiest mare at the slaughterhouse, which is always a description that I sort of
You can't get it out of your mind.
Grin ruefully about. At Sprott, we have a couple clients that are Asian parastatals. And I remember discussing with those investors the US treasuries in their portfolios. And I asked them how they felt about it. And they said that it is the deepest and most liquid reserve class in the world. And although not all the news is good, unlike other countries, we have news, which is to say, it's a fairly liquid market as well. And I suspect that those attributes will continue to make the US dollar the world's reserve currency, even as it was in the 1970s, when the US dollar experienced dramatic declines in purchasing power. The fact that you are relatively strong when everybody is challenged is not the same thing as saying that you're absolutely strong.
For sure. Would you consider gold to be better during a deflationary environment or inflationary?
History teaches that it's good in any circumstance where people are concerned about the purchasing power of their savings in conventional assets, which is to say, if people are afraid of conventional savings assets, if they're afraid of conventional financial arrangements in a deflation, gold can be good too. The circumstance that I see in front of us is very much a 1970s style stagflation circumstance where people's concerns are more inflationary. But history has shown that any time savers are concerned about the efficacy of normal savings investments, that they choose to hedge some of that savings risk with gold. And the circumstance that is in front of us, well, I'm not trying to say that it's a certainty, is from my point of view, certainly a probability that's worth insuring against.
And in terms of the current amount of gold, what is it, about 11 or 12 trillion at the current per ounce price for bullion bar? Do you think that could double in the next year or two?
Absolutely. That's different than saying it will. But if you would have asked any of your listeners 10 years ago with the on-balance sheet liabilities of the United States at $2 trillion, if they could exceed $20 trillion, if you give somebody the use of the word if in terms of macroeconomics, you can make any circumstance work for you. It's worthy to note, since you brought it up, that gold is a very under-owned asset class. Many people don't recognize that. There was a study published about 2 years ago, which suggests that the market share of precious metals and precious metals related investments comprises about 0.5% of savings and investment assets in the United States market, which is down from a 3-decade mean of between 1.5% and 2%. So,
and the institutions are probably the same.
Lower, I would suspect. We have an institutional client base at Sprott, and we're all the way to the point now where they're making allocation decisions based on gold. 4 years ago, they couldn't spell it, which is an interesting circumstance. If you think about the fact that we are confronted with debt and deficits, negative real interest rates, quantitative easing, and that the market share of precious metals and precious metals related assets is a third of the 3-decade mean, I think the probability is, as an asset class, that it at least reverts to mean.
Yeah, that could certainly be true. Are are Bitcoin maximalists, meaning intense believers in Bitcoin, and gold bugs, similarly in gold, are they actually the same people? The only difference is the vehicle they have chosen.
Oh, this hurts. I think the gold bugs are my generation, and the Bitcoin adherents are a third of my age. I don't think that they're competitive asset classes. I actually think that they're complementary asset
I
classes,
agree.
except on the really wildly speculative margin. You know, I suspect that the Robinhood crowd is much more attracted to the Bitcoin narrative than they are to the gold crowd. But the truth is, as asset classes, relative to what, the $160 trillion invested in private sector assets globally, uh, they're both very marginal players. There's room, lots of room for both relative to other asset classes. I think the Bitcoin people describe it as the new gold, and there are some gold people who are impatient for a price rise, who are blaming the speculative attraction of Bitcoin in terms of, as they see it, dampening the gold price. I see gold as irrelevant to Bitcoin, and I see Bitcoin as irrelevant to gold.
That would actually, in many ways, be good. And sure, as a store of value, and I am a Bitcoin advocate, as well as gold, uh, it is more volatile. So if you're looking for less volatility, for sure, gold has been the better bet from that perspective. What do you think about silver? Its current market cap, where it is now, and how much in the next couple of years that may increase by?
In my experience in precious metals bull markets, gold moves first because the first buyer is a fear buyer. When momentum has been established by gold, then the poor man's gold, the lower unit price material, the more volatile material, silver, takes over. Silver moves later, but then if history is a guide, it moves further and faster. A parenthetical note, the skinniest asset class in the sector are the high quality silver stocks. There are very few of them, and their market cap relative to other asset classes is infinitesimal. And the asset class in the precious metal space that has moved the furthest over time through a bull market has always been the silver stocks. These are not for the faint of heart. There are absolute risks, and they exhibit breathtaking volatility. But for people who can afford risks, who are attracted to the precious metals narrative, again, looking back in history, the most volatile asset class to the upside and then to the downside is the higher quality silver equities.
That has been true. It may be getting a little off topic, but it's staying as in commodities. If you have an opinion, I'd love to hear it. Do you think that family offices should also have probably a very modest, and how they get it, whether through miners or directly, I'm not sure, but into rare earths and uranium?
Respectively, unless they have some expertise with regards to rare earths, no. It's an absolutely treacherous market that requires a lot of knowledge. I can afford rare earths because I spent 45 years of my life studying resources, and I am comfortable with skinny, volatile markets. It's a wonderful narrative, and to the extent that you're able to trade a narrative, that's a different circumstance. That's not the same as investing. It's speculating. Uranium, by contrast, yes, absolutely, positively. A central tenet in natural resource investing away from precious metals is that you find a commodity where the supply of the commodity is essential to the lifestyle that we enjoy today. Electricity is certainly one of those. And you look at a market where, in a global basis, that market is in liquidation, which is to say the selling price of the commodity is less than the cost of production. When you find a circumstance like that, there's only two outcomes. With regards to uranium, which, by the way, although Greta doesn't like it and it's politically improper, still provides 15% of baseload electrical demand in the United States. If the uranium price doesn't recover to the cost of production, including the cost of capital, the lights go out. It's that simple. And so your family office customers need to decide what's more probable in 5 or 6 years. The uranium price going to $55 or $60 or the lights going out. This theme is the way that you invest in natural resources, ex-precious metals. The same thing could be said about oil and natural gas. It could be said about potash. Any material where the material is necessary to the ascent of man, necessary to the lifestyle that you and I enjoy, where the commodity is priced in global markets less than the cost of production, has a circumstance where either our lifestyle changes dramatically and for the worse, or the commodity returns to production cost.
Well, since you brought up oil, I'm going to have a long-winded question about it, but I think there's a little bit of logic to it. If the definition of inflation is too much money chasing too few goods, doesn't that make inflation very specific? For instance, it all goes back to relatively supply and demand. The example on oil, the demand, of course, is lower during COVID-19, but if the supply is cut more than the demand that destroyed it, since oil is needed, the price will most likely rise. What do you think will happen with the price of oil?
Absolutely critical question. Absolutely critical question. You don't have to ask Rick Rule. Go to the International Energy Agency. They suggest that the fully loaded cost to produce a barrel of oil worldwide is between $50 and $60 a barrel. So you make the stuff for 50 and you sell it for 45. You lose $5 a barrel. You do it 90 million times a day. That gets relatively boring. The stage is already set for a rebound in oil prices, the administration and Greta Thunberg notwithstanding. To maintain 90 million barrels a day production, you need to make enormous investments in sustaining capital and enormous investments in new production. That isn't taking place. The swing producer worldwide was the US shale producer. The US shale producer exhibits two things that your audience needs to listen to. One is precipitous declines, which is to say that the wells decline to the extent that 75% of the net present value of the well is produced over 18 months. So if you don't keep drilling new wells, the production falls, and that's where we are now. Baseload production, worldwide, 25% of it comes from offshore, and new field development offshore isn't taking place. In other words, precisely the circumstance that you talked about, where the capital investment to maintain current production is not taking place, will come back and bite us. Now, the oil markets, or at least the oil equity markets, are beginning to take note of this. You've seen a 35% recovery in the price of oil and gas equities. But I really think in the case of broad markets like oil and gas, that you need to do net present values on cash flows using $55 or $60 a barrel as opposed to $40 a barrel to have some sense of where those values will be capitalized at 2 or 3 years from now.
And turning the attention a little bit back to gold, but from maybe a little different perspective, I'm assuming one of the reasons why people around the world like to buy gold is really the tremendous amount of privacy it affords. I could make the argument, and again, I don't think it's one or the other, I think both, but with Bitcoin and the blockchain, I mean, it's possible for the government to reverse engineer. It's more public. They could subpoena certain exchanges. I'm not going to bore the audience with a deep dive into that. But gold could be really, really off the grid, with the exception, like 1933 and President Roosevelt, making it illegal. And if you don't turn it in, then, in theory, you're subject to a felony. So is gold the asset for those that are a little paranoid, very libertarian, the literal ownership of gold, the most off the grid asset I think that a wealthy family could have?
I would agree with all of that, but I guess intrinsically, I'm a little bit of a gold bug. It's interesting that you asked the question the way you did. For me personally, being the largest shareholder of Sprott Inc., arguably, I shouldn't have to own any gold, which is to say, if the gold price does well, my basic business would do stupidly well. But I own gold anyway, for the same reason that I own cash. It allows me to sleep nights and stay calm. I don't want to tell your listeners how to organize their life in terms of compliance, but there are some people who suggest that holding physical gold outside of the political jurisdiction that one resides in is a good idea. Again, this isn't so much a recommendation as an observation. I know that gold traditionally has operated both as a medium of exchange and a store of value. And I know from my own career, but also from studying history, that when people are concerned about even perturbations in the purchasing power of their savings instruments, that gold does well. And the consequence, as I say, is I'm sort of a gold advocate, and not necessarily to the detriment of Bitcoin. As I say, I believe they're complementary assets, albeit I know a lot more about gold than I do about Bitcoin.
Sure. And some of the things you'll hear people say, I can't take a lot of gold with me through an airport. It's not transportable. And true, compared to Bitcoin and keeping quote unquote the keys in your head or another formula. And again, they each have advantages, but they don't need to be quote unquote competitive. On gold, okay, so I could invest in mining stocks. I could do an ETF. I could do futures. Those are all going to be easy. But the true believers in gold, and especially larger families with more significant purchases, are going to start to look for physical ownership and other forms, and possibly outside of the banking system. If you could give a little bit of a quick synopsis and advantage to each of the ways that people could own gold.
Yeah, the observation that you made extends a lot to families that depend on ethnicity, which is to say, East Asian families, South Asian families, Jewish families, families that come from history that has had a traditional affinity to gold, or families, as an example, Vietnamese or Vietnamese Chinese families that have experienced catastrophic upheaval in their recent memory. The good news about physical gold, as I say, or as you have said, is that it obviates any need for trust. And if you have a circumstance where you're afraid that trust is going to break down, having the gold means you don't have to trust anybody for it. It can be inconvenient. I, from time to time, have had, relative to other people, rather large amounts of physical gold. And one thing I can say is that, as an example, buying it and physically transporting it somewhere to store it, hell, it's heavy. And it's dangerous, affecting that transport yourself. And then you have to pay it and you have to insure it. And when and if you want to turn it into other forms of liquidity, you need to reverse the process. If your reasons for owning gold are prudent, as opposed to being terrified, then the proxy forms are good enough, which is to say, if you think the challenges that we're going to face as a society are akin to the challenges that we faced in the 1970s, rather than the challenges that we faced in the 1930s, you are probably okay owning, as an example, the Sprott trusts or the Sprott ETFs. It really, I think, depends on the nature and the degree of your concern. What I would ask all of your listeners to do is, if you are going to own physical gold, pay some attention to how you store it. There are too many people, I think, who trade one set of risks for another, which is to say they store the gold at home. We call that midnight gardening. And that invites visits from people whom you wouldn't normally have over for lunch. I've had two different customers who exchanged their long-term risk of the government depreciating the purchasing power of their savings for the short-term risk, which is people visiting them that had pistols. So if you are going to own physical gold, consider storage. And once you've arranged your storage options, be very quiet about them.
That would be good advice. Is gold responsible for wars?
I think that the set of circumstances that cause gold to go up is very consistent with the set of circumstances that cause wars, which is to say, political action that is a consequence of envy is sadly good for gold, and most often the cause of war. I would suggest that gold's attraction as an asset class, I'm talking about separately from its value in religious iconography or in jewelry, has to do more with protecting one's wealth against society's avarice than it does anything else. And I think society's avarice and the avarice of the leaders of societies are most often the cause of wars. So I would suspect that gold isn't the cause of war per se, but that the thing that causes gold to be attractive is also the thing that causes war.
That is very well said. And yes, some people don't, they're like, where did that question come from? It really is out of left field, but you did a very good job. I mean, gold is really an amazing, let's say, protection from the systemic issues we're going through in government, central banks, its independency, its scarcity, its universal appeal and liquidity, and something that does make it unique, arguably compared to cryptocurrencies, very debatable. We hinted at it. And that is, cyber immunity. I mean, if you own the physical gold and you keep it in your home, you have other risk. Absolutely. But in terms of a cyber attack, that would not be one of them.
No, that's correct. And I think you need to differentiate as a gold holder between what sort of circumstances you are insuring yourself against. A circumstance where there isn't a total societal breakdown, but you have moments of illiquidity, and the consequence of that liquidity is that you debase your savings. Gold is ideal for that. Arguably, in the circumstance that you describe, and I'm not recommending this to your listeners at all, you would need to add ammunition into your portfolio. And I would hope that we get to a circumstance where that advice doesn't become efficacious.
No, we get some of that from Kyle Bass. So
he's a very smart guy. He just, he takes things to their logical conclusions, sadly. I'm always afraid to.
Yes, he does. One of our live attendee single family offices is asking, other than keeping physical gold in a bank, but if you're truly paranoid, correct or not, what are some other options besides your home of owning the physical gold? Could you keep it out of a banking system in an organization like a Brinks or a security company somewhere around the world?
There are private storage options, which in the circumstance that we are faced with today are viable options. Would those options be completely non-accessible to governments or to people searching for your wealth in the type of social breakdown that you're envisioning? I don't know. I honestly don't know. The circumstance that I see as the contingency that I'm insuring against is a circumstance that's somewhat less stark than that. I'm, as you can tell, hesitant suggesting that people take physical possession and store the gold in their house, simply because I've, as I say, had experience with 2 clients that had very bad outcomes.
Yeah, no, that would be 2 times too many and be a little scary. Yes. I mean, you also got to think of the advantage of gold is it really has no counterparty risk. Unlike other financial assets, it's Correct. Not dependent on a functional financial institutions and markets. It's no one's liability. Now, yes, again, the world goes to hell in a handbasket. You can't eat it. I get it. It's not overly transportable. So again, gold is not perfect, but in terms of a diversity from a store value and for other purposes, it's incredibly unique.
It is unique. And one of the things I found with regards to our customer base is that the customers who have the best understanding of gold, at least from my viewpoint, are customers whose family experienced great upheaval. No particular mystery, but older Jewish people who either experienced themselves or whose relatives experienced a Middle Eastern pogrom or the Holocaust. In my own experience, Vietnamese boat people who I had an interesting anecdote told me once by a customer. He said you could have segregated Vietnamese years ago by those who believed in gold and those who didn't. Those who believed in gold got out. Now all Vietnamese believe in gold. If you If you have a circumstance where the fact that you have an asset that isn't somebody else's liability, that it isn't a promise to pay, but is rather payment in and of itself, if you go through a very horrendous circumstance, it's probably the only asset that makes sense. If you just go through a circumstance like the 1970s, where it just threatens to get ugly, it's a good asset. And I need to say, we've been talking about a series of dire circumstances now. If you look at gold equities indexes going back 50 years, if you are lucky enough, fortunate enough, and smart enough to catch a gold equities bull market, there have been two in my career, 1970 to 1981, and then 2000 to 2011. History teaches us that both their duration and their dimension are extraordinary, not necessarily as an insurance asset class, but rather as an investment asset class. People asked me in 2020, well, you know, we've now been into a gold bull market for 18 to 24 months. Have I missed the boat? In my lifetime, I've lived through two gold equities bull markets, which had 10 or 11 years duration both. Similarly, the gold prices moved from $1,100 to $1,850. Have I missed the boat? Well, 1970, the gold price moved from $35 to $850. 2000, it moved from $250 to $1,900. And by the way, the equities outpaced the metal to a substantial degree. So separate and apart from gold as an asset class for the apocalypse, which I think is something that you need to consider, gold is also an asset class in terms of gold equities that fits into a more conventional equities portfolio, because when the wind is in gold sales, the bull markets are traditionally both very long and of superb dimension. And I think that family offices that have decent size equity portfolios are almost universally underrepresented in gold in what I would argue is the third year of what could easily be a 10-year bull market. So separate and apart from owning the equities to ensure other parts of your portfolio, what I think you need to consider is owning the gold equities to enhance the performance of your investment portfolio.
Yeah, so we're going to have some questions on that coming up shortly. Related, I guess, to supply and demand, how much new gold, perhaps as a percentage, makes it into the system each year?
About 1.5%, about 1.5% comes from new mine production. That's going to decline. It's going to decline because the existing supply of gold is big, and it gets tougher and tougher and tougher to augment it with new production. It's also going to decline because for at least 10 years, but I would argue for 30 years, we have underinvested in exploration and development of gold mines, which is to say that we are approaching peak gold production. It's important to note, however, that you don't view gold the way you view other commodities because gold doesn't get used. We do an odd thing with it. We take it out of a hole in the ground called a mine, and we put it in a hole in the ground called a vault. So most of the gold that's ever been mined is still supply, unlike, say, oil or something like that, which gets used up. But in direct answer to your question, about 1.5% above ground inventories seem to be augmented by between 1 and 1.5% annually.
We always appear to be hearing China and Russia keep on purchasing more gold. So the US, China, Russia, and maybe someone I'm not thinking of, I don't know, Switzerland, who do you think as a government owns the most gold? Which means they would own more gold than any entity in the world by a wide margin.
If you believe our government.
It's us.
Occasionally I do. We are the biggest gold holders in the world. If you look at the countries that are adding most rapidly to their gold holdings, certainly that's China. There is, I think, a desire on the part of societies who don't like the extraterritorial grasp of the United States to begin to diversify their holdings and their means of payment outside of the control of the SWIFT system and outside of the US dollar, which is perfectly understandable.
Yes. And in terms of back a little bit to central banks, it's a it's not going to happen. But right now, the dollar, and for the foreseeable future, is the world's currency. Could you see uh, central banks? What's the word I'm looking for? Kind of their overseer. Could you see them going to a basket of the dollar, the yen, uh, uh, Bitcoin, gold? Is there some unique combination that we could see coming that we're not seeing now that banks are using as their reserve currency? My God, even SDRs.
My answer is very cynical to that. I don't believe that any domestic political group would like to give up power. My belief is that power is the currency of politics and power is the goal of politicians. And the idea that they would voluntarily consign their power to gold, to Bitcoin, or to other sovereigns seems extremely unlikely to me. As a last result, if they had no other choice, but as a last result, they themselves might cease to exist. People ask me all the time what the probability of a gold standard is. And I don't see a circumstance where domestic political elites, or even for that matter, the voters, would like to consign themselves to the vagaries of real money. You know, the circumstance that you described earlier, quantitative easing, which is what central banks are all about,
Right.
really is a democratic function. It's a function of the war on savers, your listeners, by spenders. Spenders are much more numerous in society. And so the spenders always outvote the savers. A circumstance where we went to a gold standard would favor the savers at the expense of the spenders, which means that it would be unpopular both with most voters and also, of course, with the political elites for whom power is mother's milk.
Yeah, and the word I was looking for was I was forgetting the acronym IMF.
Right. Right.
Let me go back to the point that you made in terms of that. Again, if you just go by the numbers, the average person has under 1% of their holding in gold. That number is probably a little higher in sophisticated family offices, but it's not much higher. Whatever, we'll call it 1.5, maybe for some 2%. What do you think should, in the current environment that we're looking at, and I know the complexities of ownership make it a little more complicated, et cetera, should that be 3%, 5%, 7%? What do you think?
I think it depends on the family and what the rest of the portfolio looks like. If most of the portfolio is a private business operated by the family, where they have some pricing power, and as a consequence of the superb nature of the business, that they can defend themselves against the depredation of their savings by their own businesses, they need own less gold. A family office that's representing sort of fourth and fifth generation family, where the family business is a less important component, and particularly a family office where most of the assets are bonds, which is to say fixed asset obligations or income obligations, then I think higher gold ownership and gold equities ownership is probably warranted. Very, very recently, one of the largest pension consultants in the world has advocated that their pension clients increase their gold weighting from their prior recommendation, which was 0, to 3%.
Hey, that's a big jump.
Yes, that probably doesn't apply necessarily to family offices, but certainly a pension or an endowment where you're trying to preserve the purchasing power of your beneficiaries 20 years from now or 30 years from now, there is an argument for gold. 3% doesn't seem aggressive, but when you consider gold and precious metals market share in the US market at 0.5%, it represents almost a quantum increase in holdings.
Sure. And especially if you're talking about a family office of $1 billion plus family, I mean, that's tens of millions of dollars, especially if you're going to own it in physical gold. There is going to be the complexity of storage. And again, some may look at various options from Switzerland to Singapore to Canada to a variety of different countries, but perhaps a different discussion for a different time. But now you look at the whole commodities picture from gold to silver. We spoke about uranium, a little bit about oil. You can make the point. I had Mark Faber on right before Christmas, and he was like, ballpark about 25% in commodities. And I thought it was, it's a little high, but in thinking about it, and again, I want to be tactical, so I'm not going to say it's going to be hold it and forget it. But what do you think? If you had to add up commodities in general, do you think it should be 10, 15%, or do you think that he was correct?
If you would have asked me in 2007, when we were in the midst of commodities bull market, I would have said 10%, because I didn't see the forces in place to take commodity prices higher. Now we have a circumstance where we've underinvested in commodities for a very long time. And I see oil prices broadly higher. I see electricity prices higher. I see uranium prices higher. I see gold prices higher. So I wouldn't argue with 25%. I'm not talking necessarily in physical commodities. I'm talking about owning certainly physical precious metals, but also the commodities and the precious metals equities. And perhaps for sophisticated investors, short-term debt from commodity producers. Mm-hmm. In other words, an allocation that was 25% natural resources, particularly if that natural resources included, as my portfolio does, farmland, U.S. farmland with attached water rights. I wouldn't think that 25% would be excessive, again, depending on the other assets that comprise the family's holdings.
And we're heading a little to the home stretch. We might have time for one or two audience questions. It's funny that you brought up farmland. That came up earlier today from someone who would have similar views to you as well. And I know you have a specific focus on commodities, but we got more broadly into that, plus public equities and real estate. And so let me take two things that are real assets, so they kind of have that in common with some of your background. Real estate would be one, and you actually mentioned one rather indirectly not too long ago, and that would be families that own substantial, maybe global level income producing businesses. And those absolutely could make a hell of a lot of sense, especially in certain industries. But the one that got rocked by the black swan of COVID, and for the last 10 years, technology would be retail. But retail, hotel, office space, to some degree, arguably multifamily housing, where if you can't kick someone out if they don't pay their rent for 2 years. So that real asset, although, yeah, they're not making more of it, that's going to be a little more difficult in today's times. And who would have saw this coming?
I have done extraordinarily well as an investor in developed real estate in various classes. Always, by the way, as a passive investor. I've always invested behind a professional manager. My nervousness now is that high quality real estate seems to me to be priced for perfection. And I'm not expecting perfection. I have benefited enormously myself with the lowering of interest rates, which means that while my return on capital employed increased, my cost of capital decreased. It's difficult for me to see that continuing. I don't see interest rates going below zero for any substantial period of time, which means that the benefit that I've gotten in terms of the gap between return on capital employed and cost of capital shrinks. At the same time that I don't see continual lowering of interest rates, changing the cap rates. There was a point in time when the cap rate on decent quality developed apartments was 11 or 12. It's 4 now. So I don't see for myself that I have the sophistication to participate to the same extent that I have in real estate investments in the past, because I don't believe that the wind is in my sails. Certainly you will have in your audience some professional real estate developers and professional real estate investors who understand that they can tweak an investment in some way to increase the net present value or increase the cash flow.
And they're
I don't
buying
have
at
that.
the distressed level or getting incredible financing opportunities.
Yeah, I don't have that level of sophistication.
Right.
So
I hear you.
the prices that I'm seeing on high quality apartment buildings that were constructed in 1990 are at a level that seem to me to be priced for perfection. And I don't know enough about how to operate those assets that I could afford to own them. High quality agricultural real estate in the upper Midwest, by contrast, the rents, well, not the rents so much, but the farm gate prices have increased by 50%, while the land prices haven't increased at all. I see a circumstance where my rent increases and the asset class is becoming, literally a smaller population base. When I say the U.S. upper Midwest, that isn't to say that there aren't other places in the world that are competitive. I just don't know them as well. I like the access to the U.S. market, which is the best in the world. I like the fact that you can move crops out and move inputs in by the Mississippi River, which is to say, with water, which is cheap. We're getting far afield, but it's the only it's the only real estate asset class that I feel like I have enough information on, and that is unloved enough that I can afford to invest in it these days.
That makes sense, Rick. And this has been fantastic. I look forward to having you on a little later in the year. Very exciting. For those that would like to learn more about Sprott, how could they learn more about you, your work, and the organization?
Well, there's a couple ways. The first thing that you can do, I'm not too remote, you can email me. I'm rrule, R-R-U-L-E, at sprottglobal.com. To give your listeners an incentive to get in touch with me, any of your listeners that own natural resource stocks can go to a website, sprottusa.com/rankings. If you list your natural resource holdings there, I will rank them 1 to 10, 1 being best,
Wow.
10 being worst. And I will comment on individual issues if I think that my comments might be of value. In addition, if you mention charts, I will send out, not that I'm an adherent to technical analysis, but as a visual aid, I'll send out the Barron's Gold Mining Index chart, which is the most inclusive and longest running gold equities index in existence, to substantiate my statement that gold bull markets are long of duration and long of dimension. And I'll also include a 100-year commodity chart, which will show just how cheap commodities are relative to other asset classes, going back 100 years. So either of those ways, reach me.
Wow, that's fantastic. And I would want to give a little bit of a shout out as well. In my backyard in Greenwich, Connecticut is a colleague of yours, and maybe for those locally in Greenwich or New York, and that would be Anthony Bevilacqua. And he could be reached very simply at info@sprottglobal.com. Rick, this has been fantastic. I greatly appreciate your time. I would like to give about a 60, 90-second close, then we'll be all done right about exactly by the top of the hour. So for a change, I was good today on time. Well, everyone, I'm Angelo Robles. I'm the host of the Angelo Robles podcast. I'm the founder and CEO at Family Office Association, a global membership organization dedicated to investors, families of wealth, and their single family offices. You could learn more about us on our website as well. Very simply, it's our company name, FamilyOfficeAssociation.com. My email is angelo@FamilyOfficeAssociation.com. If you're not a member and go to the site, you'll see all we do in terms of resources, content, near daily programs like we're doing today, where you could be a live participant in, access to our library, to me, to our resources, physical events when they come back. We actually did a tiny one back in early December, so it's not totally barren at the moment. And you get a lot of benefits, including peer-to-peer communities we build online with investors and family offices in our private portals, as well as mastermind virtual classes that we host, investing family to investing family, talking and discussing what they're doing. So take a look. I'm also very active on social media. I'm at Family Office on Twitter, and on YouTube, we're simply Family Office. You could find us. So thank you all very much. And Rick, it's been a tremendous pleasure. I look forward to the next time.
My pleasure. Thank you very much.